PepsiCo's third quarter earnings and revenue beat expectations, and the stock is gaining today. The company plans to cut costs and accelerate organic sales growth next year. But our next guest thinks that is unlikely due to weakness among low-income U.S. consumers and other factors. So to explain his sell rating on the stock, joining me now is Charlie Higgs, Director at Consumer Staples Research at Rothschild Co Redburn. It's good to have you join us today. Thanks for taking the time.
Thanks for having me, Lindsay.
So you have the only sell rating on Pepsi at the moment. What do you see as the key headwinds for the company?
The key headwinds are really in their Frito-Lay North America division. It's PepsiCo's biggest profit driver, just under 40% of operating income. And for the ninth quarter in a row, we've just had volumes falling, and the company's been struggling to stabilize the salty snacks volume performance that it's had. So whilst that division is still facing pressure due to a number of reasons we can come on to, like pricing and potentially some GLP-1s in there, low-income consumer pressure, it just makes it very, very difficult for the rest of PepsiCo's business to offset that. And indeed, some of the other divisions, like the beverage business in the US, had a better quarter this quarter in Q3 if you strip out some of the bulk water discontinuation. But it's still a division that's been under pressure for a number of years now. And it basically just means that the international business that PepsiCo has to work incredibly hard to get this company to deliver what the market thinks it will.
Yeah, I mean, that's a good point, right? Like Pepsi saw volumes drop in North America, but grow in international markets. Would it not be able to make up for lost ground in that sense? What do you think?
We'll see. I mean, it's 40% of sales now from international markets. It's pretty sizable. The biggest market they have, though, is Mexico, which is just under 20% of their international sales. And we've had a number of companies out there flagging soft consumer in Mexico, largely linked to the Hispanic weakness that we've seen in the US and some resulting falling remittances. So their biggest market, Mexico, they haven't really grown volumes for 2 years in a row there now. It's all been pricing led. And as you kind of tour around the world, it's a similar picture. China has been a very soft market for a number of consumer staples companies for years now. The consumer environment doesn't seem to be getting much better. And then conversely, they've had a better performance in Europe. And I think that should continue both Eastern Europe and then also Western Europe, where I'm calling from the UK. They've got a very good business, both beverages and snacks, that should continue. So it's a bit of a mixed bag, but I guess the key point is if Mexico doesn't really turn up in 2026, again, it's quite hard to see why international is going to return to high mid-single digit growth like the company thinks it can.
Okay, let's turn back to the U.S. and some of the main factors there. Low-income U.S. consumers, like how critical is that to Pepsi's bottom line, and why is that under pressure right now?
Yeah, the company doesn't disclose it, but generally speaking, low-income consumer, i.e. $50,000 income and below, is about 30% of the U.S. population. And PepsiCo, broadly speaking, I would imagine, is in line with that across its North America portfolio. The key issue really that they faced is that in 2022 and 2023, when we had all that broad spread commodity inflation, PepsiCo and the entire consumer staples sector raised their prices aggressively. And then as we entered 2024, the low-income consumer got a lot weaker. The government withdrew things like student loan support. They cut back on some of the SNAP payments. But many of these companies didn't really adjust their pricing structure to accommodate for this weaker environment. And as a result, we've seen persistent volume declines for Pepsi's core snacks division. And going forwards, my view is, towards the end of this year, inflation will probably increase a bit in the US as Liberation Day tariffs hit. And then as we enter 2026, we then have a $9 billion SNAP reduction as part of Trump's One Big Beautiful Bill. So I guess the picture is it's hard to paint a world where the low-income consumer gets a lot better But when we hear PepsiCo on the results call, it talks about accelerating organic sales growth into next year, which seems contrary to what I see on the ground.
Yeah, I take your point. I want to go to another one of these main factors, though, and just kind of dive into it more. You mentioned it. Obviously, people's tastes are changing a little bit in the U.S. when it comes to opting for healthier, affordable options, as well as weight loss drugs. We're seeing a surge in those. Are those actual real challenges to the sector, or is this just something that Pepsi seems to be dealing with compared to its competitors?
Yeah, it's a two-parter. I think the trend towards healthier snacks isn't new. It's been going on since the 1990s, at least. But I think it really accelerated in the pandemic when everyone was stuck at home. There was quarantinis, but on the other hand, there were people taking health and wellness more seriously. And as people have emerged from the pandemic, that's continued, but particularly with the younger cohorts, Gen Z consumers, you've seen it benefit a number of products out there, Celsius energy drinks, Bellring brand, Premier Protein, etc. So kind of the nightclub, in effect, has been replaced by the gym. But those younger consumers as well, when it comes to snacking, have been seeking out healthier snacks. And for PepsiCo, that's a bit of an issue because roughly 65% of their salty snacks portfolio comes from the top 5 mega brands, Lay's, Doritos, Tostitos, Cheetos, and Ruffles. Pepsi's permissible snacks, as they call them, is only a high single-digit % of Frito-Lay's total sales. So the math just doesn't stack up. Even if that 8% of PepsiCo's Frito-Lay sales that are the healthier protein chips from Doritos, etc., grows really, really quickly, it's not going to be enough to offset the 90% of its snack portfolio that isn't in that permissible sector. And then GLP-1s, again, everyone has their own view. The data is a little bit all over the place, but the famous Cornell study that people tend to quote shows that 6 months after taking GLP-1s, household spending on groceries drops by about 5.5%, and salty snacks, it drops closer to 11. It's one of the worst affected categories if GLP-1s take off. I don't put anything in my model yet for GLP-1s. I still think it's too early. But when it comes to talking about PepsiCo's valuation, particularly relative to history, it's just an asterisk on it that means you can't really compare Frito-Lay sales growth and PepsiCo's valuation to the past.
Mm-hmm. Interesting stuff, Mr. Higgs. Appreciate you taking the time and giving us your insight. Thanks so much.
Thanks.
That was Charlie Higgs, Director and Consumer Staples Research at Rothschild Co Redburn.